Well, last episode we talked about one of my favorite tax planning strategies to help you not get killed in taxes in retirement. And if you liked that episode, you may like this episode 3 times as much because we've got 3 more tax saving strategies to cover with you today.
Welcome to the Financial Pathway Podcast. We're here to help you go to the next level in your finances with practical advice from speaker and financial planner Nate Skeller.
You, as a financial planner, one of my favorite things to do is to help clients find creative ways to save on taxes. I heard another financial planner put it this way, and it completely echoes my feelings around the subject. He said, you need to be honest and pay every cent of taxes that you are required, but there is no requirement to leave Uncle Sam a tip. And I think there's a lot of people that have a sense of resignation around taxes. Like, I guess the taxes are what they are. And it's because taxes are so convoluted and because they're so difficult to understand. I think a lot of people just, they gather up their pay stubs and all their statements at the end of the year, hand it into the tax preparer, and they just kind of cross their fingers and hope for some good news. But what if there were some proactive things that you could be doing ahead of time before you sent in that paperwork to make sure that you're going to minimize that tax bill ahead of time? That's what I want to talk to you about today. As I said in the last episode, disclaimer, consult with a tax professional before implementing any of these strategies. I am not giving you tax advice, simply giving you some examples for illustrative purposes and some education around these topics. Make sure that you seek out advice before implementing these strategies to make sure that they're appropriate for you. So let's jump into number 1. Have a plan for your RMDs. What does RMD stand for? That's required minimum distribution. If you have money in pre-tax accounts like a traditional IRA or a 401k or 403b, you will need to pay taxes on that money when it comes out. You got a tax deduction ahead of time. You didn't pay taxes on that money when it went into the account, but you will have to pay taxes when it comes out. And once you reach a certain age, the IRS is going to require you to start taking out at least a minimum amount every single year, whether you actually need it or not. But if you're smart and you plan ahead, there are some ways to make sure that you minimize the taxes around these and maximize the value of your money. Now, one of the ways that you can do that is through something called a QCD, a qualified charitable distribution. The way this works is, let's say your required minimum distribution for this year is $5,000. You have to take out $5,000 out of your IRA. Well, the IRS allows you instead to make a qualified charitable distribution. And instead of receiving that money directly, you can send that money to a charitable organization like your church or a 501c3 nonprofit. And as long as that money is sent directly to that charitable organization, that can come out as a tax-free withdrawal because you did not receive it and use it. It was given to a charitable organization. So in a situation where maybe you don't need that money, it's only coming out because it has to, you may be able to utilize that for giving and for charitable purposes, and then avoid adding to your tax bill for that year. Another option is, let's say that you have to take out a certain amount, but you are still working and you still have earned income. You have a 401k through your job, or even if you don't have a retirement account available to you through your job, you still would be allowed to make IRA or Roth IRA contributions for that year if you have earned income. So again, if you had to take out $5,000 out of your IRA because the IRS is requiring you to, you could turn around and take the same amount and put it back into a retirement account. And if it's a 401k or an IRA, get the tax deduction and basically offset that income, or put it into a Roth IRA and say, okay, sure, I have to pay the taxes on it now, but at least I can set it aside for later and not have to pay any taxes on this money later on. Another thing to keep in mind is if you have inherited an account. There are new rules around inherited accounts. Unless you are a spouse, for most other people, you will need to be taking that money out within 10 years of receiving that account. So if it was an IRA or a 401k, an account where taxes have to be owed on that, think about how you want to space that out. A lot of times what happens is a parent or a grandparent or a loved one will pass away, and that beneficiary will receive that account, and it's like, oh, there's $200,000 in this IRA, and I have to take this out in the next 10 years. I'll just go ahead and take it out now and put it into a savings account, or I'll use it for a down payment on a house. And certainly, while it may make sense in some cases to go ahead and take that lump sum out and deploy it for some purposes, that is almost always the IRS's favorite option, because you're going to receive all that money as earned income for that year. So it's going to be added on top of your other money, and it's going to push you very, very likely into a higher tax bracket, meaning you'll pay more taxes on that money as opposed to spreading that out. Now, if you've inherited an account from somebody who is already past the required minimum distribution age, you still do need to take out the required minimum distribution for that account, but that doesn't necessarily mean you'd have to take all of it out. So it may make sense to space those things out so that you're not paying more taxes than you need to over that 10-year period. Another option or another consideration is if you have a 401k, let's say through your workplace, and they offer Roth contributions, or if you're making contributions for yourself personally, just in individual retirement accounts, you may want to consider doing a Roth IRA. And one of the reasons this could be beneficial is Roth IRAs do not have required minimum distributions attached to them. So if you have a Roth IRA or a Roth 401k that you've rolled over into a Roth IRA, there is no requirement to take that money out. Reason being is you've already paid taxes on that money. So therefore the IRS is in no rush for you to take it out because they don't stand to collect any taxes on that. So have a plan for your RMDs and make sure that you're not paying more taxes than you have to when it comes to that area. Number 2, let's talk about paying attention to the order of your withdrawals. What does that mean? Well, there are many different types of retirement accounts out there, like we talked about, traditional accounts, Roth accounts, but many people have just regular taxable accounts. They're not necessarily a tax advantaged retirement account. They're just a regular account, or maybe a trust account. And each account has different tax rules associated with it. Are taxes owed when you withdraw? Are taxes owed before you make contributions? Are taxes owed on growth throughout the year? And that's different for each type of account. But when it comes to your retirement, let's say you've got a traditional IRA, a Roth IRA, and a taxable account where you have to pay taxes on any growth on that account during the year, whereas your traditional and your Roth accounts, you don't have to be paying taxes on the growth each year. You don't pay taxes until that money is taken out of the account. Well, the order in which you take money out of those accounts does matter. You say, okay, I've got a traditional IRA, a Roth IRA, and a taxable account. Which one should I withdraw from first? Generally speaking, it makes sense to take money out of the taxable account first, the traditional second, and the Roth last. Now, why is that? Well, it's because the Roth IRA is tax-free. Therefore, you're giving the tax-free account the most amount of time to grow and gain money because all of that money is going to be able to come out tax-free. Whereas the taxable account, because you're having to pay taxes on dividends and interest on that money every single year, that's a drag on your return. And therefore, it usually makes sense to go ahead and withdraw from that account first. Also, consider something called asset location. In other words, if I have multiple different types of accounts, what types of investments do I hold in each account? A lot of times for people, they'll hold basically the same types of investments in all of their accounts. And maybe early on, that might make sense, but especially around retirement, that may not be the best strategy. For instance, like I just talked about, because it usually makes sense to take out the money out of the taxable account first and save your Roth account for last, what about putting your more growth-oriented investments in your Roth account because they have the highest likelihood of the highest return, and putting your more conservative investments in your taxable or in your traditional account because those are going to be accessed sooner. It's something to consider and may make a huge difference as far as the amount of taxes that you end up owing on those accounts. Also, consider the inheritance of accounts. Like we talked about in our previous point, if you have inherited an account and it's subject to that 10-year rule, well then you may want to consider, okay, how do we invest that account compared to compared to my other accounts? It may make sense to have your inherited account invested a lot more conservatively and shift more of your growth-oriented investments into those other accounts that you'll be accessing later. And then thirdly and finally, another great tax-saving strategy is using tax-friendly investments. There are 3 in particular that I should mention here. One is municipal bonds. This is a very helpful investment for those that are in high tax brackets and are investing their money in taxable accounts. Now, if you have a traditional IRA or a Roth IRA, municipal bonds aren't really going to help you in those accounts. And if you're in a low tax bracket, municipal bonds also probably aren't going to help you. But let's say that you're in the 32% tax bracket, you live in a state with state income tax as well, and you have your money invested in an account where all interest and dividends that are accrued in that account each year are subject to tax. Well, municipal bonds, generally speaking, are not subject to federal income tax, and depending on your state, may not even be subject to state income tax. A municipal bond works very similar to a CD at the bank. You buy the bond, it has a stated interest rate that it pays for that length of the bond. So normally, if you put your money in a CD or in some type of corporate bond and you're getting interest, you're paying taxes on that money, and you're paying taxes on that money just like it was earned income from a job at the highest tax brackets. If instead you put your money in municipal bonds, that can all be tax-free. Now keep in mind that you have to compare apples to apples, because municipal bonds generally pay lower interest rates than other types of bonds, but when you consider how much of your interest is going to be cut out with taxes, it may make sense to put your money in municipal bonds, but you always have to look and see what makes sense for your situation. Another one is U.S. Treasury bonds. Similarly to municipal bonds, U.S. Treasury bonds have some tax advantages too. Not as good as municipal bonds, but still a helpful feature. U.S. Treasury bonds, generally speaking, are not subject to state taxes, still subject to federal taxes. Usually state taxes are a lot lower percentages than federal taxes, so not as beneficial as municipal bonds. But again, you have to look at your situation. If U.S. Treasury bonds pay more than municipal bonds and you don't have to pay state income taxes, you have to look at the after-tax yield of these investments and see what might make sense. But again, for a lot of investors who have high or are in a high tax bracket and have their money in taxable accounts, U.S. Treasury bonds can make a lot of sense. And then the last one is using investments that pay out qualified dividends. And most stocks that pay out dividends would be paying out qualified dividends. And what this means is if it's a qualified dividend, it is taxed at the capital gains rate and not the ordinary income tax rate. So most of your pay, like your pay from your job or interest from your checking account, your savings account, CDs, bonds, these are subject to ordinary tax rates. And that's the 12, 22, all the way up 32, 37%, at least what they are right now, the various tax brackets based on your income. But capital gains are different. The capital gains rate starts at 0% actually, then goes up to 15, and then goes up to 20, much lower than ordinary income taxes. So it may make sense to, again, based on your tax bracket and based on what type of account you have, to invest money in things that pay out qualified dividends so that that money is not being taxed at nearly as high of a rate as other investments. Now, in all of this, whether it's your RMDs, whether it's the order of withdrawals, whether it's the investments that you're choosing inside the accounts, don't let the tail wag the dog. What I mean by that is sometimes people are so bent on saving on taxes that they'll actually use a strategy that is less efficient. You know, that they'll spend $1 to save 20 cents, that sort of thing. So saving on taxes is great, and as much as we're able to, we want to save on taxes, but we don't want to make decisions that are actually not in our best interest just so that we can save a few cents or a few percentage points on taxes. If you found today's episode helpful, then I hope you will subscribe to the podcast, which is Financial Pathway, and the YouTube channel, which is Nate Skelly CFP, and you can get more content just like this. Thanks as always for listening. I'll see you on the next one.